we'll have Dewey, Amy with Summit Mortgage.
Everybody. So this is actually the third time I've spoken at this with Birdie's invited. About a year ago, right?
Yeah, a year and a half.
A year ago. Okay, so I kind of came up with a theme when I was driving over here today. It was Clint Eastwood, the good, the bad, and the ugly. Right? So you can kind of hear the theme. Because I feel that way every time I walk up in front of this group, or any group at this point as a mortgage guy. But it's really not that bad. So I'm going to go over a few things, and I'm going to kind of stick to that theme, the good, the bad, and the ugly, but I'd obviously like to start with the ugly, okay? We all watch the news at some point, right? You can't get away from it these days. It depends on what channel you're watching, or who you're listening to kind of get an idea of what's really going on in the world. You know, is it too good to be true? No. Is it really as bad as it seems? Sometimes. Okay, so the ugly, realistically, where we're at right now, anybody here heard of shadow inventory of foreclosures? Anybody know what that is? Okay, shadow inventory of foreclosures are actually the homes that are in pre-foreclosure or have not been actively foreclosed on yet, the banks aren't actually putting on their books. Okay? Kind of cooking their own books by not actually putting those numbers out there. Okay? That's real. And there's a lot of them. The statistic I just heard today was that month over month in the past year, month over month, in the past 12 months, there has been more people 90 days delinquent in succession. Okay, so every month, more and more people are becoming 90 days delinquent. Okay, so the people on the news that we hear talking about, oh, everything's great, the economy's recovering. The public opinion of the economy is that it's all getting better, right? Not necessarily the truth. Okay, not necessarily the truth. And one of the things that really ties into that would be the jobs numbers. Now, I am in this business, and I have to watch that because jobs numbers really do affect interest rates quite a bit. Last month, and there's reports that come out every month as well. Last month's report initially showed that there was going to be, or estimated there was going to be 430,000 jobs created. Anybody hear that figure? Heard that figure, right? Did you hear that 411,000 of them were for temporary census workers? Okay? How do you paint the picture? Okay? How do you paint the picture realistically? That all being said, and we've been through a lot. A year ago when I was here, I'm surprised Bert had me back, but you know, he did. But we've really come a long way, but we're not through the rough patch by any means, I don't think, at this point. If you looked at the Clark County numbers for, I think, the first 4 months, so the first, 3 or 4 months of the year, you will see that prices are down again. Now that's on average. Every area is pocket. Okay, every area is pocket. You might live in an area where it's been doing really well. You might be in an area that's been hit pretty hard, but we're probably, I think, if I recall what the number was, it was about 10% down this year. Okay. Goldman & Sachs did a report as I think it was June 8th, where they predict Seattle's going to be down about 22% this year, and Portland roughly about 18%. We're generally lumped into that. Okay, it is what it is, guys. It is what it is. We were all, drunk with incredible appreciation when the numbers weren't real, right? I mean, the years that we were getting 25, 26% appreciation, that wasn't realistic. Okay, so what we're really doing is we're coming back to the normal. Okay, and you have to kind of understand that and weigh that out as to what your plans are in the future. Okay, so that kind of brings me. That's the other. Okay, those aren't the greatest things that you've ever heard anyone say. And it's probably not even original. You guys have all probably heard that or thought that before. The bad portion of what's going on these days, it's kind of good and bad, but we'll kind of go over it a little bit. Lenders. Okay. First of all, I'm going to go back a little bit, or kind of give you a little bit of background. There's basically 3 different types of lenders out there right now. Did everybody know that? Probably not. Okay. There's your retail banks. Anybody here work for a retail bank? Key Bank, a credit union, anything like that. A Bank of America, Chase. I would say Washington Mutual, but they're not around. That's a retail bank. So literally, you go into your bank and you sit down with a mortgage person, and they decide whether they're going to give you a loan, right? There's also wholesale mortgage brokers. Everybody understands the theory behind wholesale. Pretty much everybody in my industry that did what I did was a wholesale mortgage broker. Okay, so I was approved with about 100 different lenders. Okay, so you would come to me and say, Dewey, I need your help. Great, I'll help you. I'm going to go shop through these 100 different lenders, really. I mean, I had 100 that I had access to, thousands of programs, literally. But we generally worked with about 10 of them that were good and we knew what they were going to get done. Okay? Then those guys, retail basically has become very difficult to get anything done with. I keep rescuing loans from this, that, and the other. Wholesale, they're basically being let out to slaughter by the government. Wholesale mortgage brokers, it's becoming more and more difficult for them to make a living. The wholesale lenders themselves, it's becoming more and more difficult for them to lend money. Okay, which brings us to what's called correspondent lending, which you may or may not have heard of. Correspondent lending would be the company that I'm with now, Summit Mortgage, been in business about, I think, 10 years. Multiple lines, multiple warehouse lines of credit. Okay? What that does is it actually eliminates a lot of the layovers that your general lenders are going to have. Okay? So debt ratios, whereas KeyBank or a big retail shop might have a staunch debt ratio at 45%, credit scores need to be 660. In a correspondent realm, you can actually eliminate a lot of the layovers. Okay? And why do I go over that? Because the thing that you need to understand is you need to know who you're going to see. And you need to know what your situation is, or you're not going to fit. And it's not real fun going in someplace, sitting down, give them all your information, and have them turn around and say, I'm sorry, Mr. Smith, you just don't qualify. Right? Okay, so kind of know going in what you're looking at and where you're going to be. As far as lenders right now, Fannie Mae, a year ago when I was here, nobody really wanted to, or a year and a half ago, nobody really wanted to lend money. That's changing, okay? That's changing. There is money to be had. You just have to qualify, and they're making it a little bit more difficult here and there, okay? The government's come out with regulations on appraisals, which I've talked about here the last few times I've been here, which have become difficult at times. It used to be someone who's been in the industry like me about 14 years. I had established appraisers that I worked with. The reason I had established appraisers that I worked with was because I knew that they were going to do a good job for my client. Okay? If there was an issue with value, I could call them beforehand and say, hey, is there going to be an issue with value on this? Yeah, there might be. I could let the client know that. We could evaluate at that point, and maybe they wouldn't be out $450 for an appraisal. Okay? These days, things have all changed. There's a governor, Mario Cuomo. Everybody heard of him? Okay? Came up with the great idea that lenders, loan originators, should have no contact with appraisers. Okay? Makes a little bit of sense. The reason being because he felt that that relationship was really coloring the real estate landscape. Okay? So what it's come to now, as opposed to me calling one of my local appraisers here in the area, and I'll tell you that I just was trying to help a lady in Woodland with a loan. Her appraiser was from Wana, Washington. Does anybody know where that is? Gig Harbor? 2 hours away, 2.5 hours away, right, from Woodland? Does that make sense? Okay, that's bettering the system. Basically what happens is I get online, I type in your address, and then an appraiser comes out and he appraises your home not knowing anything about you, and I don't know anything about him, and I can't talk to him about the appraisal once it's done. Okay? And once the appraisal is done, basically it's done. Makes it a little bit more difficult. So that's one of the things that we have to deal with. And what we're talking about here, as far as timber framing, it could be very difficult, right? What if you have somebody who's not really familiar with the kind of project you have going on? That could be an issue. Okay, so you just go into these things with open eyes.